Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Welcoming you here for another monthly recap with the gentlemen, lead partners from New Harbor Financial, one of the financial advisory firms endorsed by Thoughtful Money. I'm joined as usual by John Lodra and Mike Preston. And I've asked them to come here this week because there has been so much going on in the markets just in the past week alone. A lot of curveballs that many people didn't see coming. China's DeepSeek, obviously a shot out of the blue. The tariffs being applied as quickly and furiously as they were, and then some of the immediate fallout from that that's still ongoing as the time of this recording. It's obviously something that has been keeping the markets on its toes, but also getting investors, I think, understandably, kind of nervous and a little bit overwhelmed. So wanted to bring the guys on. We'll get their reaction to a lot of these big developments that are going on. But also try to just ground it in, okay, practically, what does this mean for the average investor? What should the average investor consider doing here? So, John, Mike, thanks so much for joining me, guys. Look, like I said, lots going on. Maybe we start with the tariffs and the trade wars, just because that is going on fast and furiously at the day that we're recording this. And folks, I apologize. I'm sure some of the things we're talking about will probably be old news, in the 24 hours it takes for this video to get edited and posted. But let's see, John, why don't I kick off with you here? So we've had, just to set the stage, we had on Saturday the Trump administration apply tariffs to several of its largest trading partners: 25% tariff on Mexico, 25% tariff on Canada, 10% tariff on China, and 10% tariff on Canada's energy exports. So those were given a slightly less punitive tariff. So a lot of dust has been kicked up in the air. Markets were pretty deeply in the red Sunday night going into this week. But then as they opened, very quickly we found out that Mexico is sending 10,000 troops to the border. So Trump is giving them a month reprieve on the tariffs there. I'm sure there are going to be several other things that have happened by the time this video gets posted. But what are you guys watching? What impact do you expect this to have? And then let's get down to, okay, what does it mean for investors?
Great. Yeah, thank you, Adam. Great to be with you here. And look, we are getting exactly what we should expect by the proclaimed tweeter in chief, right? If we thought we were going to get anything but rapid fire headlines and news items, we'd be fooling ourselves, and we're getting exactly that. Let's take a step back. Let's talk about, we'll get into the details here, but let's really just take a step back and bring it to a broad takeaway for the kinds of folks that we serve, everyday clients that are, obviously they're worried about the news, and there's plenty beyond financial markets to be worried about today. So a lot on people's minds, and at the end of the day, our job is to help sort through what's signal, what's noise, and really what it matters to their financial security. And taking a step back, let's talk about where we are in the market cycle. We've talked ad nauseum, frankly, but very much relevant, and we'll keep making this case. We are in very, very extreme valuation territories for the U.S. stock market anyways. So, it doesn't mean anything in the short term insofar as a timing tool, but it means, if history's any guide, it means a very significant amount of relevance for what it likely means over the next decade for returns in the stock market. So, when you have valuation extremes like this, it's kind of like a crackling fire that you put a open gasoline can next to. Doesn't matter what spark from that fire goes into the can to ignite the can, any spark will do. And that's what these kinds of headlines could eventually turn out being. It's the cumulative effect of headlines of tariffs and the DeepSeek and all that stuff that starts to erode away at the can do nothing wrong kind of market in the eyes of investors. There's been a tremendous amount of bullishness and sentiment and heavy positioning in stocks, for example. That'll change, but it's going to take a market action and the psychology collectively to shift. These developments are very noisy. It's very, we're not going to sit here today and say exactly what's likely to happen because we don't know. It's unknowable. Nobody knows. In fact, it takes quite a bit of hubris to make a bold claim about the exact ramifications of tariffs, whether the tariffs end up even going into place or not. But in the spirit of that, I want to kind of share a couple of anecdotes from Trump's first term, because I think it will help make a point here. So here is a chart that basically shows in his first term a number of trade tension type of headlines, and spanning the 2018 2019 timeframe. And it shows basically those major things. And yeah, they're different than the news of the recent days, but it still makes a point. What you can see here, if you look at the world index, world stock market index, both on a daily change and 1 week change from those announcements, rather much a nothing burger. So one key takeaway here is there may be sectors of the market, sectors of the economy that end up getting hurt more than others if these things come to pass. But that just underscores the importance of having a tactical approach that is not wedded to any one sector or theme, but can be flexible and respond to leadership and laggardship as they express themselves in the market. There's a big question mark if tariffs do get put into place. What does that mean for inflation? Well, here again, we don't know for sure. Even just like, let's talk about Scott Bessent, the new Treasury Secretary. Even he has put out conflicting messages about what tariffs mean insofar as inflation. Some of his interviews said, yeah, they're inflationary. Some of them said, no, they're not. So even the right up the Treasury office is sending mixed signals. This is a chart of inflation going back to 2018. And you can see during Trump's first term, during the period of those trade actions, we had moderating inflation. Then, of course, we saw a big spike in inflation into 2022. Here we are today, where inflation rates have moderated and actually have started to turn up. So we're kind of in a different environment here. No time is exactly the same as others. So the jury's out. There very well could be that tariffs this time do incite an inflationary thing because of the backdrop that we're in right now. And the market has already started to price inflationary concerns in. This is a look at 5-year break-even rates. It's the imputed market expectation of inflation. Right here is where the Fed cut rates last year, September of 2024. And from that point on through present day, we've seen nothing but rising inflation expectations by the market. This is 5-year inflation expectations. They're right back at the highs that we saw back in January of 23. Not nearly where we were in 22, but this is a concerning picture, at least the trend anyways, and it certainly has, for example, the Federal Reserve concerned, and they've expressed that in their recent meetings about rate cuts and the need and willingness on their part to be extra patient here because they don't want to have inflation return prematurely. So I'll pause there. Plenty to unpack there, but there's some big takeaways. The main thing is everyday people need to tune out the headlines. Doesn't mean you go to sleep, but it means it may be more a question of, are you positioned properly at a macro level, not in response to headlines, but as relates to your own life and your financial security.
Yeah, and that's a great point, which is if you find yourself kind of losing sleep over whatever developments are going on in the headlines, it very well may be a good sign that you might need to de-risk your portfolio. That's your mind telling you that you're too exposed to whatever potential concern is keeping you up at night. So let me just ask sort of the practical question here, John, which is, what, if anything, are you guys at New Harbor doing right now? How has this changed or not changed your current investment outlook? And are you making any changes in the portfolio at this stage based upon anything that's been going on with these trade wars?
Simple answer is no, we haven't changed a thing. And part of that is because we've already been positioned what we perceive and believe to be in a very proper way with, very much a conservative defense-minded positioning already in place. So this is not worrying us one bit in the sense that we've already been in a defensive posture because of a whole host of things, not least of which are extreme valuations. We've had very whippy sentiment and very whippy technical indicators over the last couple of months. Right now, those technical indicators, a spectrum of breadth and momentum and moving average type things. Right now they're actually leaning positive, leaning bullish. Nothing has happened in the 48 hours since Friday to dramatically change those indicators. We'll watch for erosion there, and we'll take corrective action and incrementally more defensive action if and when that happens. But we don't need to anticipate. We can kind of look at the market action itself. But we went into this with plenty of defenses in place so that we don't need to be worried about this.
Okay. All right. Mike, coming over to you, obviously, feel free to add anything on top of John's observations there about the tariffs. But I want to come to you and have you talk for a little bit about gold. I've been getting just hammered ever since the weekend's news for an update on gold because a lot of people think that that's going to do well in a trade war. Both from a risk-off standpoint and if tariffs prove inflationary, some people see that as the inflation hedge. So anyways, can you tell us what's going on? And maybe just to quickly set the stage, as we were coming into the overnight market at the end of the weekend, major indices were down pretty big, 2-3%. Cryptos were down really big, but gold was actually up. And the day we're talking here, Monday, the first day of the week, gold is still up for the day. So it's hung in there. It is, if it's not at right now, it's quite close to its all-time high. Tell us what's going on with gold and where you think it may be headed from here.
Okay, Adam, I'm going to bring up a chart and I'm going to quickly look at the broad market here. Then I'll answer your question about gold and just
Sure.
further to what John was saying here. In just a second, you should be seeing a daily chart of the S&P 500. And so this market has been nothing if not whippy. The market is an emotional beast because it's made up of emotional people. And particularly at these valuations, it's extremely dangerous. But look at what's really going on here. This is a daily chart. This red line is the 50-day moving average. For the most part, we've been respecting that. Down here at the purple line is where we have our hedges on a piece of our portfolio, about a 15% hedge, because we've got about 40% stock exposure. 15% of that comes off if we go below that purple line. That's because that takes out all the swing lows and the big breakaway gap back here a few months ago. But last week we had the DeepSeek thing that came out, the DeepSeek news out of China, that basically they have developed a LLM or large language model that learned over 2 months at the cost of, I think, $5.8 million, basically an AI engine that competes with the likes of ChatGPT. And it does so for much less money. At least those are the initial headlines. Well, the market sold off
And just to
hard.
clarify that tiny bit, there has been some coverage coming out, unclear how much of it's true, but that China maybe had access to some of NVIDIA's GPUs there and to train it. And they might have spent upwards of $1 billion on that. And even if that's true, it's still a tiny fraction than what the other large language models have spent.
Well, you see, that's a good example there, Adam, right? I mean, everyone freaks out, and here over the next 5 days, the market climbs right back. And so the initial reports about being 5 or 6 million may or may not be true. And yet the market doesn't wait to find out the details, does it? It just sells off. And we'd be the last ones to tell you not to worry about anything in this market because this market is treacherous. It's emotional, it's volatile, it's overvalued. But over the balance of last week, it mostly came back. And then look, another Monday. So 2 Mondays in a row where the futures were down over 100 S&P points. I can't remember the last time that happened, actually. But the market, even today, as we speak, is already up over 100 points off the low. And if we close right here, we're closing in about 35 minutes, we're going to close over the 50-day moving average. And by the way, this high last week of 61.28 is less than 2% above where we are right here. So again, this is not to say don't worry, but if your allocation is correct, and by correct, I mean low, and you've got some good hedges in, you really shouldn't worry too much yet because this market's trying to shake anyone and everyone out. And yes, we do think the market has a date with destiny and it's going to go down hard, but it's impossible to say whether that's soon. So that's the S&P. I'm going to answer your question about gold. I'll just bring up an ETF here on gold. This is a daily chart on gold. Gold hit a new high today. And so it's got this nice basing, this cup formation over the last couple months. Each segment here between these dotted lines is roughly a month. So over the last 3 months, we have this nice formation breaking out to a new high. Let me go to a weekly chart because I think it shows it even better. We've got 6 weeks straight up here. And if I were to show you the dollar over the last 6 weeks, let's just do that quickly. For the most part, we've had a couple down weeks in the dollar, but over the last month or so, the dollar, and certainly over the last few months, the dollar's been really strong, moving from about 100 to 110 on the basket. So going back to gold, we think it's pretty impressive that gold has staged this breakout and has done so even with the backdrop of a really strong dollar. So, and if I went back even further on gold to the monthly chart, here's the big cup and handle that we've been talking about here for years. Basically a 10 to 12 year cup and handle that broke out early last year and has yet to look back. This is a really strong uptrend. It seems to be doing so no matter what the dollar is doing, and it's one of the best charts out there. And so we like gold. We've got a position in bullion. We've got a position in miners. The two together are about 10%. We think that miners are going to catch up. It takes a lot of patience to say that and to live through that for the people that are out there in miners. But gold looks fantastic. And so, at the moment, both gold and stocks look really strong. We think that gold is the safer bet. And, we think that gold stocks will catch up.
All right. So I got a number of questions here for you, Mike, if I can jump in. Pull that chart of gold back up if you can.
Mm-hmm.
So lots of encouraging patterns in the chart as you walked us through. What I want to note here is what moving average is the red line there?
This is the exponential 50-day moving average.
It's the
The
50
green
day.
one's the 21-day, and then this is the 200-day down here.
Okay. So, you know, just because we bring this up for the S&P and we point it out as a negative, with this run, gold is fairly distanced above those moving averages, right?
Yes.
And if they play catch up, great. But is there sort of a risk of a stretched elastic band here where gold just gets too far above its Bollinger Bands or its trading range and even just technically needs to snap back?
Yeah, I don't have Bollinger Bands on the chart. I could put them on here. Bollinger Bands in general show you what plus two and minus two standard deviations look like. I'll tell you one thing I've learned in my career, though, Adam, is a lot of times an asset can climb right along the upper edge of the Bollinger Band or the bottom edge of the Bollinger Band. And so it's hard to say. If you look back here to July of last year, we certainly got stretched and we did indeed have a pullback. So I guess in the short term, if you were to look back here, you'd say, well, it would be a lot smarter to wait. But, what about here? This is a big breakout back here in August, and we were well above the moving average, and we never really came down to the 50-day. We kind of went sideways. And this asset happens to be GLD. We went from 230, to 260. That's a 300-point move, a $300 move in gold, and we never corrected. So, I wouldn't play games. If you're trying to establish a position, I would get a position on, particularly on a breakout, because you never know when we're going to come back in. If you have a position and you're looking to trade an extra position over and above that, then I think you've got a valid point, that you might want to wait for a pullback to at least a 21-day or something like that. But we could spike right up. I mean, at any time, any of these assets could really have a real breakaway gap. So you're playing games if you're trying to cut it too tight here. So
Right. Well, and especially too, sorry to interrupt, but we're right now in an environment where there are a lot of non-market forces, non-market surprise forces going on, right? So tariffs, right? It's not something we can predict with certainty until it just happens, right? And that's something that can kind of change people's outlook overnight about an asset. So point being is just yeah, it's a little bit more of a hard to predict game than if we were just assuming a free and efficient market, right?
it's
Adam and
true.
Mike, I actually have the Bollinger. Let me pull it up just to so we
Going
can
back to let me just finish this though. But going back, if I went to the monthly chart, Adam, just as an example of what this looks like, look at this breakout. This was roughly a 2000 on gold. If you waited for a pullback to the 50-month moving average or even the 20-month moving average, it hasn't happened still.
Yeah.
All right,
Well,
I know
let
we're
me just
talking about
let me
different
just ask
time
this question because
frames.
I'm gonna ask some bullish questions about gold in a second. But let me just say, Mike, if that were a chart of Nvidia, would you
Uh-huh.
be warning that it was too overvalued?
I would certainly, yes, I would certainly tell people to be careful to take a look at asset allocations. But still, I mean, I know Nvidia is a little bit different than gold. Um, I would tell them to be careful if they're overexposed for sure, you know.
Okay.
But for somebody that doesn't have a position or has a very small position, I think that I wouldn't try to fine tune it too much.
Okay. And I'm not trying to talk anybody out of gold here. And full disclosure, I still hold all my gold positionings. Um, But and like I said, there's a lot of people that are thinking, hey, Adam, don't mention this at all. This is the moment we've been waiting for in gold, and it's finally going to get turbocharged and find its true price level and all that stuff. That might be all true.
It might
But
be.
I'm just looking at some of these charts and saying, I'm kind of thinking if we were looking at an equity, we would be saying, it's looking a little overstretched. Um,
It's true. But the thing I've learned about equities too is don't short them on the breakouts.
well, yeah.
Because they can just go so much farther than you think. So, there's a big difference I know between buying a position for investment purposes and shorting something on a breakout. But my point is that even stocks like Nvidia or Apple or any one of them that break out, they can double and triple before they top out, even when they look stretched.
Yeah, got it. Hey, John, did you want to show the Bollinger Bands there?
Yeah, not to beat a dead duck here, but let's just complete the thought here. Um, so this is the same GLD chart. I have 50-day Bollinger Bands on here, so the red and the purplish line there. So here's the breakout Mike talked about, triangle breakout. So yeah, we're hugging up that 50-day upper Bollinger Band. But you go back here, there's plenty of instances where it can walk up that Bollinger Band, not in a straight line. There very often are healthy pauses and whatnot. And we don't need, frankly, this to go higher right now, and we don't need to anticipate that it will because we can take defensive action. We actually did put some very out of the money hedges on the gold mining stocks last week. We'll see if that was needed or necessary, but like with anything, you want to kind of keep your position size appropriate. And we spent a lot of our time challenging our own convictions, frankly, and what could go wrong and what are we not thinking. So nothing is ever as easy as a straight line, and we know that all too well. But
Yeah.
as of right here and now, the technical picture for gold is very, very constructive.
Great. And again, that's why I have you guys on the channel here is to let people know how real capital managers have to think through this stuff in a real-time basis. So let me ask a potentially really bullish question for gold. So Mike, you were showing in your charts that, gold's been on a big run and you use the term irrespective of what the dollar's been doing. And you showed the chart of the dollar and the dollar's been going up. And generally, the correlation between gold and the dollar are negative, right? A rising dollar usually is correlated with a lower gold price. Not all the time, but usually. And that hasn't been the case for a while now. And a lot of people think that that's gold sending an important message here, right? That things are different. Um, my question to you there's a lot of people who are thinking that the dollar, well, who knows where it's going to go in the immediate term, is likely for a bunch of reasons uh, going to weaken over the next couple of years. And folks thinking that even though he wouldn't necessarily say it, that would help President Trump and a lot of his goals as well. So let's assume for a moment that that does happen. Let's say that the dollar, weakens through the rest of this year. Would we be looking at that as additional tailwind behind gold, or just do the historic correlations just no longer matter?
Well, no, I think the historical correlations do matter. And nobody knows for sure the right answer here, Adam. But the way I look at it is that gold is going up despite a rising dollar, and I think that if we see a reversal in that, it will be further fuel for dollars rise. Now, will we actually see a reversal in the dollar in the near term? I don't know. We can argue that a lot of different ways. It seems to me like we're going to get an asset price drop. And when that happens, there's going to be some kind of flight to safety. That's the whole dollar milkshake theory that Brent Johnson talks about. And I think that's probably right. So I wouldn't be surprised to see an even stronger dollar in the next year or two,
Okay.
but
And just to make sure folks understand that what you're mostly talking about there, if I'm interpreting Brent's theory correctly, is that capital around the rest of the world will be getting beat up even worse than us. And so that flight to safety is going to come from the rest of the world into the US, largely at that point, probably into treasuries, the safety trade. And that will then strengthen the dollar.
That's the theory, and it makes sense to me. It may not happen that way, but it makes sense to me. I'd like to think that gold will still keep going up if that's the case. But I have to admit, we might be wrong. I might be wrong, and the dollar tops out right from here and drops, which would be a nice surprise. So, I can say that based on the charting that we do, that 107 level on the dollar was pretty important when it broke out above there. It came back and tested it, and now it's at roughly 110 or so, I think. Yeah, 109 actually right now. So as long as it stays above 107 or so, I think that the path of least resistance is up. But if we get a surprise move down on the dollar, I think that would be great for gold. I just don't really think we have a good way to predict that either way. Right now, the technicals say higher dollar for the very near term.
Okay, but your gut tells you if the dollar starts weakening, that should, again, give gold a little bit of an extra tailwind here.
It would be a bonus. Look at it as a bonus.
A bonus. Okay, Mike, do me a favor, pull up the chart of GDX. So GDX is an ETF for the gold mining sector, or at least the gold mining, the major companies in the gold mining sector, but it's a good proxy for how that sector is performing. Now, do me a favor, Mike. So one, it's somewhat lackluster here over the past year, right? This is about a year chart. Now it did bottom, in around Christmas time, and it's been going up since. But do me a favor, go do like a 15-year chart. Okay, so you showed that gold was at its all-time high, right? Where mining stocks, which are supposed to be a leveraged play on gold, are not. And in fact, they're still pretty far below their all-time highs that they saw, about 14 years ago, 13, 14 years ago?
Back in 11, yeah. It's been frustrating to say the least.
Yeah, so for folks that are just scratching their head and saying, why? I've been buying mining stocks over the past bunch of years because of this relationship, and gold's done everything I hoped it would, but the miners just didn't follow suit. Why?
Yeah, the ratios are still out of whack. The gold to XAU ratio, XAU is the mining index, is way out of whack. And so many of us that follow this space have been thinking that there's going to be a reversion, and I still think there's going to be some kind of reversion. But at the same point, we can't completely throw out the window some realities in the sector. For instance, the cost of production has steadily been creeping up. Newmont Mining came out a couple of months ago with a surprise report that knocked that stock down hard right when the mining stocks were taking off. Now, most of them have recovered. The leaders are back to new highs, like AEM, Agnico Eagle Mines, back to new highs roughly. Wheaton Precious Metals is another leader that's recovered quite well. And as you can see, that the GDX has recovered pretty well. It's not back to its recent high, but there's been some destruction here because the cost of production or extracting gold out of the ground has gone from something like $800 to $1,000 up to like $1,600 to $1,800, depending upon who you listen to and what report you tune into. So that's one reason. There's been a lot of value destruction here with bad acquisitions and bad investments by CEOs over this whole decade. I think they thought that trees were going to grow to the sky back here. And so a lot of them admitted they made some bad decisions. But still, the value destruction seems to be worse than warranted. And of course, you get the same old concerns about political risks and different countries saying they're going to nationalize mines and that type of thing. But I don't have a chart handy, but if you look at gold XAU ratio, it's still in the doldrums. We're talking like 20-year lows. And it would just take a small normalization of that to snap these miners back up to roughly where this line is at the 50 level, 50 to 55. I can see this level being achieved if gold does what we think it will do and shoot up towards 32 to 3,400 from here in the next year. So maybe we're not going to get the big multiplication that we thought we'd get, but I think that a partial move towards an equilibrium here could snap this thing up really fast, particularly if there's some short covering. So, and that would be a pretty big move. We're almost touching 40 here on GDX. So if we went up to 50, that would be a 25% move. And you might see that with gold only going up something like 10% from here. 2,800 to maybe 3,200 might bring this up to, and that would only be 10% on gold, might bring this up 20 or 30%. So we still think there's a pretty good opportunity in miners. I will say one last thing. We do look at the relative strength performance of miners versus bullion, and it's that data still favors bullion, which is why we have 5% bullion and 5% miners now. But if we start to see outperformance in miners, our data will show it, and we'll very quickly sell some bullion and we'll increase our mining position.
Okay, that was actually the next question I was going to ask you. So thanks for anticipating it. Last question on this, and then John, I'm coming back to you. Just to round out the story here, can you just pull up a chart of silver real quick and just give us any update there? Silver, similar to the miners, is really nowhere near its all-time price high that it hit back in 2011. What are your thoughts on silver here? Is it
Well,
something you
silver
guys
kind of
think is a
moves
good
a
play?
lot faster and more volatile than gold. So it had this blow off back here in 2011, which is probably unwarranted, but and then it's had this just ridiculous bear market. Gold was down 40%, silver was down almost 80% from its high, right? And it spent all these years in the same cup formation I just showed you in gold. It went through a similar terrible long consolidation here for anyone that was in silver. And then we had this huge, 4-year consolidation in a triangle that broke out early last year when gold broke out. And so this is SLV. It's going to be a little bit off of the spot price. But silver went from basically 20 to 30 in a span of a few months. And now we're bouncing around right now at around 32 in spot, which is about 29 in SLV. I think this is really a bullish formation. It's a big triangle here, and if gold breaks higher, then silver is going to break higher. And I think the next levels in silver would be up here around 34 on SLV, which would be around 38 to 40 on silver itself. And silver can do that quickly. I mean, look what happened back here. It went up 10 points in 2 to 3 months, and it could do that again, particularly if people start chasing and short covering starts to kick in. Silver has a history of having monster moves that are compressed. And it's just another good example of how not to get in the way of a big breakout. Imagine if you tried to pick the top back here. Sometime, and again, I don't know Bollinger Bands, but this would have been outside of the Bollinger Bands the whole time. So sometimes if you're long, just hold your position, assuming you've got the right position size, and let it work. And at least with a small piece of your position, don't try to pick the top. It's a really hard thing to do for an investor, even for a professional, because everyone wants to sell the top, but it's impossible. And so the last thing I'd say to people that have big positions in silver and gold, and we've got a lot of them as clients and people that talk to us, you have to be emotionally okay with selling on the way up. If you have too much of a position, and it's different for everybody, but if you've got 50% in gold and silver, and we talk to a lot of people like that, you should be picking levels for you to slowly sell a little bit on the way up. And you have to be happy that it keeps going up afterwards, because after all, that's what you want. So that's the kind of move I think we're going to get.
All right. Okay. Well, thanks so much for walking me through all that. All right. So, John, coming to you now. So you and Mike started your careers as engineers. I'm not saying that you've got any real unique expertise when it comes to evaluating AI and large language models as a result of that engineering degree, but you think technically. Um, uh, we had China shock the world by releasing DeepSeek, about a week and a half ago. And the world's now had a chance to process the results, and the market has pretty much decided, we're not that worried. NVIDIA aside, and maybe one or two other stocks aside as well. But the big question that I still wrestle with is, look, the AI race is now more uncertain than it was 2 weeks ago. And whether it took 5 million, to create DeepSeek, or a billion, cheating off of the papers of the other AI companies. What China showed the world is, hey, there's a way to program AI software in a way where you can get pretty much the same results for an awful lot less cheaper. And it can be made free to everybody. And for everybody can have it. Everybody can, open source, they can tweak it, they can customize it any way they want. They can run it on machines that don't require super expensive NVIDIA processors. So, you know, what final impact is that going to have when the dust settles? I don't know. Nobody else knows. But it's something that should be applied as a discount factor. And it doesn't seem the market's doing that yet, right? And you were talking about, it was you or Mike, I can't remember which, but we're talking about how, the market's now had sort of several bolts out of the blue, but it's still hanging in there. And that's why we talk about the importance of sentiment, that it really takes a while to shake Wall Street out of whatever sentiment mode it's in, especially if it's in a sentiment mode that's been running and running successfully for a long time. And for a very long time, buying the dip, just holding long and buying dips has worked. And so it's probably going to take some more shocks to shake the market out of that. So two questions for you, John. Are there any big implications for you think are coming from DeepSeek that we should talk about here? And then secondly, to my point about like market shocks, we clearly seem to be in a more volatile year than we've had in the past several years. And a lot of other guests on this program have been predicting that and then corroborating that in recent interviews. Does the danger increase as we go along with more volatility, that we keep getting surprise after surprise and nothing changes, nothing changes, nothing changes. Then all of a sudden you get that surprise that really does cause sentiment to change. And then we could have a very different market very quickly, maybe catching a lot of investors by surprise.
Yeah, so the whole DeepSeek thing is noteworthy for a lot of different reasons, even just beyond the headlines. And I want to call out the live session you did, Adam, with Charles Hugh Smith. I actually listened to that on one of my commutes home from work, and I thought it was a great summary of what we knew then. And I'm not a technologist, Mike's not, and I don't even play around with the AI products that much, to be completely honest. But here's what I think it means. So first of all, this market for the last several years has been very narrow. Okay, we know that it's been a fairly narrow cohort of stocks, and it's the very stocks in the AI ecosystem that have been more or less the backbone of this market. There's been periods of expansion of breadth into other sectors, but by and large, the last couple of years of market advance has been very narrowly on the stocks like NVIDIA and some of the AI cohort. So that's meaningful, and looks like you're gonna, so you get your perfect. I mean, in a picture, this about says it all, right? So anything
Sorry,
that
had to get that in there.
yeah, and of course, markets valuations are. I think it was Aswath Asmadorian. I forget how to pronounce his name, but he put out a tweet the other day. He's like, to him, valuations is the bridge between numbers and a story, right? So a big part of valuation, or what the market's perception of valuation is, a story. It's a story of, hey, NVIDIA's got this moat. They got this not only chips, but they got the software that runs the chips that is untouchable by anybody else, right? They're so far ahead. And I think this news basically put a real chink in that narrative, not just a rumor, but a real vision as to how maybe this doesn't need the kind of resources, expensive chips and whatnot that NVIDIA puts out. And certainly the market has so far. Let me just share a chart of NVIDIA just to kind of look at it from a kind of an individual standpoint. This is a daily chart of NVIDIA. Basically we were in a trading range here, late last quarter and into this year, and we've soundly broken down through that. We're below the 200-day moving average. So there's definitely been some technical damage in this stock. Take that for what it is. I think there's some interesting maybe lessons to be gleaned from maybe the tech bubble back in 2000 to 2002. And let me just share some perspectives of that. And this is not meant to be a forecast. It's just to show how a narrative can change, even though the hype around that narrative turns out to be everything that it was believed to be and more. So, for example, this looks at private investment in IT equipment and software, basically, as a percentage of GDP. It goes back to the mid 90s. You can see this massive run up in the tech bubble, and then this massive cliff down in that spending. who was benefiting? Companies like Cisco, for example, they were the NVIDIA of the internet revolution. Everybody needed Cisco routers and data handlers and things like that to power the servers and the internet, right? Now that came off a cliff. Now we haven't seen the same degree of a run up there, so maybe we're in early innings here. But you look at what happened to Cisco stock. This is a total return graph of Cisco stock. It took over 20 years to kind of get back to even. That was an over, I think, 80%, maybe even 90% price drop. But even including dividends along the way, took 20 years to get back to even, right? Even though over that same period of time, this is the trailing 12-month revenues. Revenues for Cisco kept growing and growing and growing, 216% increase over that period since the peak in 2000. Yet the stock is only up 17.5%, not even a percent a year over that time frame on a total return basis. Now the internet turned out to be everything we expected and more. It's just simply that the stock got so far ahead of itself in terms of, and this I'm just picking on Cisco. So I think it's a very I think instructive example of how even a great stock like NVIDIA, even if it continues to do great innovation, it's not quite as untouchable as perhaps as the market has assumed and priced into the stock.
Yeah, yeah, and look, we could have had that conversation. We did that conversation many times prior to DeepSeek, right? So forget for a moment the new potential competitive threat that DeepSeek introduces. We had lots of conversations about this concern of just pulling too much of tomorrow's value into today, that market valuations had gotten up to near or at all-time highs, right? And that's largely through multiple expansion. And I just want folks to understand that when we talk about multiple expansion, we're essentially saying we're pulling more of tomorrow's value into today, right? So you're enjoying it today, but we're stealing it from the future, meaning you need to expect weaker returns in the future because we're taking them today. And too many people, I don't think that. They just think, oh, it's going up, momentum's building. That means it's going to be even better tomorrow. So they're literally developing the wrong expectation.
Yeah, and Adam, I'd like to bring this back to our toolkit, right? We don't need to anticipate. We can kind of watch this unfold in the market. We've seen a narrow leadership of, for example, the tech space the last couple of years. Let me just share a page from one of our dashboards. We look at all kinds of data. Let me just share you one example of the data that we look at. So this is a ranking of the various sectors on a relative strength basis. Basically these numbers here are kind of a degree to which, for example, the financial sector is, kind of scoring positively on a relative strength basis compared to all these other sectors. So basically green and the darker green represents the strongest sectors, right? And then I'm looking at over the last 3 years on a bi-weekly basis. So you can see the sectors that have been really strong, no surprise, financials, technologies, communication, industrial, things that have been weak of late. So this is as of the end of last month. Healthcare, basic materials, energy, consumer staples, basically. But if you go back over time, that changes. Let's go back to 2022, for example. So here's 2022. Look at technology was out of favor, but energy was in favor. So, we spent a lot of our time not trying to anticipate these changes, but to watch them unfold in these systematic metrics that we routinely. So this guides, for example, our allocation to sectors. Right now, we're overweight things like financials, technology. We have equal weight exposure there, so we're not heavily exposed to the big mega cap tech stocks like NVIDIA and Meta and Apple. We have communication services. We're in industrial, so we have all those sectors represented. Right now, we're not in. We sold healthcare several weeks or months ago. It started to break down, and here it's registering very weakly on a relative strength basis. We don't really own any focused areas in energy right now. We own some MLPs, which are different play in energy. They're not a commodity play. They're a throughput play. These are master limited partnerships that are basically pipelines, and they collect a toll, if you will, for shipping the product. So these trends will change, and it's important to have a system to kind of guide where to put your eggs in the basket along the way.
I really appreciate you showing that. It's a great visualization of when you guys talk about investing for the markets we have, not the markets we wish we had, right? Hey, maybe we don't think banks should be getting the love they are right now, but that's what's hot right now, right? Don't fight it, right? Don't stand in front of these things. You were talking about don't sell an equity when it's racing above its Bollinger line. Yeah, you don't necessarily want to stand in front of that steamroller either, right? So, all right. Well, look, in starting to wrap things up here, couple quick closing things. One is you said you're not a technologist. I'm definitely not a technologist, and I have said that, especially in my conversation there with Charles. Since that video, I have been reached out to by real technologists, people who have spent their career working with large language models. And I will say, without revealing anything specifically, that they said that they're nervous. Like they don't think this is a flash in the pan. They don't think this is something to shrug off. They think that this has really changed the game pretty materially, and that the markets are being blind to that right now. So just a little FYI there. Also, the whole tariff trade war thing, we're doing the best we can to analyze it here, folks, in real time. Pretty much while we've been talking here with John and Mike, news has been breaking. One, right before we got on here, I was watching the market start to recover today, guys, and I saw, okay, the S&P is down by not as much, Nasdaq's down by not as much, and I looked at crypto and like, wow, crypto is taking off. Why? And then about an hour later, we get this announcement that President Trump has just signed an order, I guess, that he wants to create a sovereign wealth fund for America, right? So, okay, now the big debate's on, right? Okay, what should go into that sovereign wealth fund? Obviously, a lot of crypto folks think that crypto could be a big part of it. This could be part of the strategic Bitcoin reserve and whatever that's going to mean. So let's watch that closely, guys. And maybe next time you're on, we can talk about what that means. As we've been talking about, I've been getting news alerts that Trump, I guess, is on his second phone call of the day with Canadian Prime Minister, at least Prime Minister for the time being, Justin Trudeau. And there's, speculation that just like Mexico got a pause this morning because it agreed to send troops, that maybe there's going to be some agreement stricken with Canada, maybe by even the end of today. So by the time you're watching this, folks, maybe that's one of the new developments. But the point is there's just a lot going on, and that's the point I want to sort of wrap things up here with you guys on. Is there is just so much uncertainty swirling right now, volatility, we talked about earlier, that for the average investor who, I think, from what people tell me, feels somewhat challenged in being the steward of their own wealth anyways, just because they have real lives, right? Hey, I've got a job I got to work, I got a family I got to take care of, I got things I got to do. To try to stay on top of these markets it's a tall order, and that's why people are coming online to channels like this and trying to self-educate. But a lot of them, tell me, I'm doing it because I don't like my broker, or I haven't found somebody that I trust yet, but I don't want to be the one doing this because I don't feel like I'm the best person. I'm the best qualified person to be doing this for me. And their job has just gotten a lot harder this year with all these curveballs that are now just coming fast and furious. And they're trying to figure out, oh my gosh, how do I interpret this? And what changes do I make to my portfolio? And now do I got to buy these stocks over here or sell those ones? So you guys talk to people day in, day out, your existing clients, as well as people who watch this video and take you up on the free consultations. Do you guys have any feedback for that person who is just feeling, spun around by these, crazy dramatic changes that are now seem to be happening on an hourly basis? And anything you can kind of tell them to just hopefully help them make some better decisions moving forward?
Adam, as I said before, the market is an emotional beast, and it's not really fair to people. I think that central banks have used emotion against people. The whole wealth effect is a psychological game, right? We have to have it, otherwise we can't service the debt. But people feel this disconnect. It doesn't feel quite right. Things don't feel real anymore. Valuations don't feel right, even in the housing market, not even just the stock market, the housing market too. So people are confused. And so we're happy to talk to them, and we talk to them all the time. Go to thoughtfulmoney.com. In the upper right-hand corner, there's a free consultation tab, I think. Click on that and put your information in there, and we offer a free talk with everybody.
Yeah.
And
Actually, Mike, just to correct it, that is true, but even more so, there was just a great big enter your email address here, right at the center of the front page. So
perfect. Do
easy
that
to
too.
find, folks. Super easy to find.
Do that too. But big part of what we do in our job is psychological support. Honestly, I mean, people want to talk to us so they don't feel crazy. They want to talk to us to get a litmus test for what they're doing. Is it right? Is it wrong? And there is no right and wrong, by the way. There's shades of right and wrong. And so with our experience, we can talk with people and help them kind of see if they're on the right track. Most of the conversations that I've had in the last couple of weeks have been just people wanting to know if they're close to being on the right track. And trust me, with all the people that we've talked to, all the hundreds and even thousands of financial plans that we've done over the years, we can very quickly ask some questions and find out if you're pretty close to where you need to be. And I think that's a big thing that we do. We manage money, we're good at it, we're good at the technicals and all that in terms of, in analyzing the market. But the truth is nobody knows what's going to happen tomorrow, right? Particularly in a very overvalued market, anything can happen. So I think a big thing that we help people with is help ground them psychologically. We can apply our experience to their situation and help them feel good or maybe not good about their situation, depending upon what the case may be. But most of the time, even if the situation isn't great, we can help them feel better just by making some small changes and some suggestions. So happy to do it. It's what we live for. It's what we work for, and we're grateful to do it.
All right. John, anything you want to add to that?
Really not too much. It's just really bringing it back to people's own lives. I mean, so many of the clients we talk to are going to be okay so long as they don't mess things up, right? And usually in this stage of the market cycle, the form of messing things up is taking way more risk than this market deserves.
Yeah.
These valuations, don't feel like you got to get every last bit of speculative return out of a very elevated market. That is a recipe for undoing a very good thing. And that's, our clients don't get a do-over. Most of your listeners probably don't get a do-over. And that is something we got to firmly kind of remind folks about and help them manage the emotions of, kind of the impossible headlines that come out every day that want to set them astray.
All right. Well, really well said, guys. And look, there's a spectrum of investors, right? And a certain group is the do-it-yourself investor, right? And if you're a do-it-yourself investor, that's fantastic. As long as you've got a pretty good track record at it, I think that's totally fine. And channels like this exist to hopefully help give you access to expert insights that you can use in your decisions around how you're going to manage your portfolio, and hopefully they make you a better investor. And that's great. And there's even services like Lance Roberts, at RIA, they've got the Simplevisor solution there, right? Which essentially is sort of like a highly affordable Bloomberg, right? Where it's a tiny fraction of the price, but you get a lot of the same value in terms of data and screens and all sorts of other things that can help you. So it's a great time to be a DIY investor. But a lot of people either don't want to be a DIY investor or honestly probably shouldn't be a DIY investor because they just don't have either the temperament or the skills or the experience or the time to do it, right? And so those kind of fall into two main categories. One is the person who knows what they want to do. They just want basically a quarterback. They want to be the owner of the team, to be able to tell the quarterback what to do and then let the quarterback actually run the plays and come and report back to them. So if you're that type of person, obviously I think you should find a good financial advisor who can play that role for you, and you can be, highly involved, make sure they're doing everything you want them to do. The second is somebody for whom investing is just, it's a little overwhelming, but they know they need to do it, right? And this was to your point, John, about really not wanting to do something wrong. Now, none of these investors want to do something wrong, but a lot of the fear I hear is from people that reach out to me and say, hey, look, a good example, somebody just contacted me recently who lost their spouse, and they had, they got control of the estate, and they don't feel comfortable being their own financial captain because they just don't have the experience. That's something their spouse did. They have children that are depending upon them to make this money really last. And this person, is getting near retirement age, isn't going to be working forever. So they're like, look, we really need to make sure that this money does what I need it to do for the rest of my life. And so much of that is around, okay, well, let's put together the financial plan. Let's figure out all your assets and resources and needs and, payment schedules. And let's try to come up, what do you need to have by when? And once you have that clarity, to your point, John, you oftentimes realize, hey, we don't need to try to beat the stock market every year. to get you where you need to be. We can actually get you to your goals with pretty good confidence with a lot less risk. And when you're able to do that, you're able to make a big difference in somebody's life, but you're able to take such a huge weight off of their shoulders because they realize that they don't have to be running with the big dogs and somehow figuring out how to outperform them. They can maybe take a much safer course, but yet still get where they need to go just with a lot more confidence and a lot less worry. You're kind of nodding as I'm saying this, guys. But anything else you want to add to this?
That's really it. Sometimes just even addressing the unknown, even if the bringing the unknown into the realm of awareness, even if it's not a perfectly rosy picture, can in and of itself be stress reducing because the unknown is the most stressful, right? At
Right.
least if you know a realistic assessment, at least you know what you're dealing with. We humans hate uncertainty, right?
Yeah,
Even
my
uncertainty
my wife,
that is, yeah,
as you guys know, my wife's a therapist, and one of the exercises you go through is helping people name their fears. Right? They come in with a lot of anxiety, a lot of worry. Well, if you help them actually name their fears and put them out on the table and kind of put them out in the light of day, that's the first step to releasing the control the fears have over them. And very similar to what you're saying. Yeah.
absolutely, Adam.
All right. Well, look, folks, your understanding here, I hopefully, the real value that financial advisors can bring, not just in, helping you hit your financial goals, but bringing you hopefully the discipline, the guidance, the structure, and the partnership to hopefully help you hit your goals faster or hit your goals with a much greater degree of safety. And then thrown into the mix there is maybe a little bit of therapy as well, because as we've talked about in the past, a good financial advisor oftentimes finds themselves being, part-time therapist as well, because money creates all sorts of emotional issues for us humans. But the reason why I'm digging into this so much today, folks, is because of this whole topic about higher uncertainty, higher volatility. If you've found yourself getting kind of whipsawed and a little disquieted by the action in the markets over the past, week and a half, I don't think that that's something that's going to go away quickly. I think we're probably going to see more of that going into this year, and that's not just my opinion. That's the opinion of the majority of folks that I've been interviewing recently, which is why I wanted to bring it up here. All right, so with that, gentlemen, thanks for joining me for yet another week. Folks, if you've enjoyed having a dedicated session here, if you like these dedicated monthly sessions with the guys from New Harbor, please let them know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. As we've mentioned, if you'd like to get some help from these guys, whether it's John and Mike in New Harbor or Lance Roberts and his team, or Jonathan Welland's team up in Canada, if you're Canadian, feel free to schedule a free consultation with one of the advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, enter your email address right in that box on the front page there, and it'll bring up a short form. It'll take you less than a minute to fill it out. The firms will be in touch with you right away, and there's no commitment to work with them. These are totally free. It's just a free public service that these firms offer. And while you're there at thoughtfulmoney.com, don't forget to go to thoughtfulmoney.com/conference and sign up for our spring online conference, which is coming up fast. It's going to be Saturday, March 15th. And the faculty is going to be amazing. If you watched this weekend, you heard me announce that Sven Henrik has just joined the faculty. So it's a killer faculty already. But I'm telling you, folks, we've got like 3 or 4 other really big names you're going to love that I'll be releasing over the next couple of weeks as their schedules get finalized. So I can say already right now, hands down, this is the best faculty we've ever had, and already includes Sven, Lacey Hunt, Luke Roman, Brent Johnson, Darius Dale, Michael Howell, Louis Vincent Gov, Melody Wright, Stephen Bavaria, Jeff Clark, and like I said, there's still several other really big names to come. So very excited to share those with you when I finally get them locked in. And a reminder too, if you're thinking about going to the conference, go get your ticket now because we're offering it at the lowest early bird price. That price isn't going to be around forever. I want to make sure everybody else gets the lowest price they can. And if you are a premium subscriber to our Substack, you get an additional $50 off of that low early bird price using the discount code that I've already sent you guys in your email there. All right, John and Mike, thanks so much, guys. Really appreciate you joining me again this week. Again, lots going on here, so I'm sure by the next time you come on, there's going to be, just a whole flood of other things to talk about. So stay tuned, stay on your toes, boys. Everybody else, thanks so much for watching.
Thank you, Adam. Always a pleasure. We'll see you soon.
Thank you, Adam. We enjoyed spending this time with you and your audience. We appreciate the opportunity, and we'll see you soon.